Hello and welcome back to Global Value. Today we're performing a fundamental stock analysis of General Mills Inc., ticker symbol GIS. So we're looking at General Mills as a subscriber request. Currently the business is trading for $80.64 per share, and over the last year General Mills' stock price is up 20%. So this is in drastic contrast to much of the rest of the market over this time frame. So we're analyzing the business today to understand what are we missing? What could the market have possibly discovered about this business this last year that's led to this kind of outperformance? So over the last 5 years, General Mills is compounding their stock price at just under 9% annually. Over the last 10 years, General Mills is compounding their stock price at just over 5% annually. And going back prior to the global financial crisis, over the last 18 years, General Mills' stock price is compounding at just over 6% annually. Keep in mind that the company does pay out dividends. Currently, General Mills is paying out an above average 2.6% dividend yield. So this is above the yield that you'd be receiving from an S&P 500 ETF. So General Mills' average dividend yield throughout this 18-year time frame would be in addition to their compounded annual return in their stock price. So currently General Mills is about $8 below their 52-week high. They're about $19 above their 52-week low. General Mills is a large business. They have a $47.5 billion market cap. For more background about the business, General Mills is a leading global packaged food company that produces snacks, cereal, convenient foods, yogurt, dough, baking mixes and ingredients, pet foods, and super premium ice cream. Its largest brands are Nature Valley, Cheerios, Old El Paso, Yoplait, Pillsbury, Betty Crocker, Blue, and Haagen-Dazs. In fiscal 2022, 77% of its revenue was derived from the United States, although the company also operates in Canada, Europe, Australia, Asia, and Latin America. While most of General Mills' products are sold through retail stores to consumers, the company also sells products into the food service channel and the commercial baking industry. Additionally, the company operates 466 leased and 392 franchised ice cream parlors. General Mills Inc. was founded in 1866 and is headquartered in Minneapolis, Minnesota. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist style approach of 6 standard financial metrics to come to a holistic and beginning understanding of General Mills based off of their business fundamentals. So this analysis is still a work in progress and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital. So by looking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So General Mills has increased their returns on capital throughout this time frame. In their most recent fiscal year, the business earned about 13.5% returns on capital, and over their last 12 months, they're earning just over 13% returns on capital. So while their returns on capital are increasing and they're earning solid returns on capital that are above those of a typical business, General Mills is going to be falling just short of our 14% benchmark. Overall, throughout this time frame, the company averages about 12.5% returns on capital in a given year. And so this is going to be an X here on metric number 1. Even though that is a handful of percentage points above the average business, that's still just a couple percentage points below that 14% benchmark. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric will be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be looking at General Mills' last 12 months worth of numbers in our calculations here. So over this time frame, General Mills has grown their revenues modestly by about 23%. Their earnings are up slightly faster than this, growing at about 36% over this time frame. And their free cash flows are slightly up from where they were in 2018. Their free cash flows have grown by about 10% over the last 5 years. So all 3 of these are up here for General Mills. This has been growth across their business, and they've increased their returns on capital, which are better than those of a typical business throughout this time frame. So even though it's not crazy growth here, this is still solid growth nonetheless, and this is a check here, our first of the day on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at General Mills on a per share basis. So we're looking for earnings per share growth over the last 5 years. We just learned in our previous metric that their earnings have grown by 36% over this time frame. However, we still want to look at what they've done in terms of their shares outstanding, as that can have a significant impact here. So General Mills throughout this time frame has diluted existing shareholders by about 3.5%. So while this isn't too much shareholder dilution, ideally we want a business to be keeping their shares flat, or better yet, buying back their shares when they look like they're trading for below their intrinsic value and it looks like an attractive use of capital relative to some of the other businesses' opportunities. So 3.5% shareholder dilution is not a lot, but it's not necessarily ideal, because when you're purchasing a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a company issues new shares and dilutes existing shareholders, they're ultimately decreasing the percentage of the business's profits that you're going to be entitled to. So even with this slight shareholder dilution, their earnings growth is outpacing this, and so this has led to earnings per share growth over the last 5 years for General Mills. Over their last 12 months, General Mills has earned $4.79 for each share that they've had outstanding. Next up, metric number 4 is going to be very similar. So here we're looking for free cash flow per share growth over the last 5 years. A very similar story to their earnings per share. We've learned that General Mills' free cash flows are slightly up over this time frame, and they're just modestly outpacing their shareholder dilution. So this is a check here on metric number 4, as General Mills has grown their free cash flows per share over this time frame. Over their last 12 months, General Mills has produced $4.07 worth of free cash flow for each share that they've had outstanding. And so far, through our first 4 metrics, to recap, we have 3 checks and only 1 X for General Mills. Next up, for metric number 5, here we're evaluating how the business is using debt. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. So General Mills has been steadily decreasing their net debt position over this time frame. They've continued paying this down since the end of their most recent fiscal year, and currently the business has about $11 billion worth of net debt. And over these last 5 fiscal years, General Mills has produced $12.9 billion worth of free cash flow. So that's enough free cash flow to be able to comfortably support this debt load, and it's especially helped that the business has prioritized paying down this debt over this time frame. So this is a check here on metric number 5, as it looks like relative to the business's abilities to produce free cash flows, they're using a reasonable amount of leverage in their business. And over their last 12 months, General Mills has produced $2.45 billion worth of free cash flow, which, if we were to extrapolate that over the next 5 years, would also be able to cover their current net debt position. So it looks like General Mills is using a healthy amount of debt, again, relative to how cash flow generative the business is and has been over the last 5 years. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may potentially offer us an attractive risk premium to the yield of the 10-year treasury, and it may provide us with a reasonable starting point for a valuation of General Mills. So General Mills currently has about a $59 billion total enterprise value, and we're using their enterprise value because it takes into account both their market cap and their net debt position, and it will give us a perspective of the business that's more similar to as if General Mills were a private company. We learned in our previous metric that General Mills has produced $12.9 billion worth of free cash flow over their last 5 years. This means that in an average year, General Mills produces about $2.6 billion worth of free cash flow. So when we divide their $2.6 billion of their average free cash flow by their $58.9 billion total enterprise value, that is going to give us around a 4.4% average free cash flow to enterprise value yield for General Mills. That's just slightly below that 5% risk premium we're ideally looking for, although this is coming in above the yield of the 10-year treasury currently. So while we're close here, unfortunately, this is going to be an X on metric number 6, as it looks like we're just not getting the adequate risk premium that we're ideally desiring. Also, to keep in mind, we learned that the business has produced $2.45 billion worth of free cash flow over their last 12 months. So to get a current free cash flow to enterprise value yield for General Mills, when we divide that $2.45 billion of their current free cash flow by their $58.9 billion total enterprise value, that gives us about a 4.2% current free cash flow to enterprise value yield for the business. So these free cash flows are slightly down from what they've averaged over this time frame, even though they've grown over the last 5 years. So their current free cash flow to enterprise value yield is offering an even smaller risk premium compared to what their average free cash flows were at. So both on a current and an average basis of their free cash flows, this is an X here on metric number 6. Just because this is the case doesn't mean that you're going to write General Mills off entirely. This is still just one of our 6 metrics, and these metrics are meant to be taken in holistically. Even though they're simple, when they're combined together, they can be very powerful. And keep in mind that this is not a buy or sell recommendation of any security. It's not financial advice, and there's still some interesting aspects of General Mills that we need to cover. Then here as a bonus, we're taking a look at General Mills' dividend profile. So currently General Mills is paying out a 2.6% dividend yield, which is well above that of the dividend yield of an S&P 500 ETF right now. However, it's important to stop and look at the underlying fundamentals of a business and to determine whether a company's abilities to pay out dividends are well supported by either their earnings or their free cash flows, depending on the type of business, because people make the mistake of blindly chasing dividends all the time. So if you're potentially interested in General Mills, in part because of its abilities to return cash to shareholders through its dividend, it looks like General Mills has been able to comfortably support their dividend yield over the last 5 years, and they've managed to grow this overall, although they kept their dividend payouts flat from 2018 until 2020. The business has been able to comfortably support their dividend payouts, and it looks like they've kept their dividend payout ratio below 60% in all 5 of these years. So this means that General Mills' dividend looks like it's in potentially healthy and sustainable shape going forward into the future. However, please keep in mind that this is a snapshot of their last 5 years, and that past performance is no guarantee of future results. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze General Mills, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for General Mills. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of their free cash flows over their last 5 years, and we're using historical growth assumptions based off how General Mills has grown their average free cash flows dating back all the way till 1990 in order to project these out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be accurate and applicable going forward to give us a baseline projected estimate for General Mills over the next 20 years. If we assume that General Mills grows their average free cash flows at a rate of 5.5% annually over their next 10 years, and then in the 10 years out after that, that this growth rate would slow down to growing at a rate of 4% annually, we won't be adding in their tangible book value because that's been skewed by about 2 decades worth of share buybacks for General Mills. So the accounting here is not going to be necessarily reflective of the economic reality of the business. So that's something that you would want to dig into, and that's an assumption that would better inform this model. But with that caveat aside, if we were seeking a 15% rate of return from General Mills, which is the rate of return that Warren Buffett is ideally looking for from his investments, in addition to his margin of safety requirements, which will vary based off the dynamics of the industry that the business he's looking at is in, as well as the durable competitive advantages that that business may possess, then based off today's valuations of General Mills, it looks like a potential fair intrinsic value for the company is just below $40 per share. That's about half of General Mills' current stock price. Keep in mind some caveats here. One, we would not be doubly counting their dividends, so this 15% rate of return would be including their 2.6% dividend yield. 2 is that a discounted cash flow model is based off the predictability of a business's future free cash flows. So while General Mills has had higher business predictability than some other types of businesses in the past, it seems like they were only slightly more predictable than a typical business, and that this is not necessarily going to be the case for the business going forward. So again, you would want to dig in and really understand the business in more depth. Also, this 15% rate of return would be drastically outperforming how General Mills has fared over their last nearly 2 decades as a public business. So please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for General Mills, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support the key points around a potential long or a potential short thesis of General Mills? So starting with some of the key points around a potential long thesis for the business. Number 1, General Mills' well-developed strategic revenue management and holistic margin management programs should help the firm offset steep cost inflation. Number 2, the firm is modernizing its brand building capabilities with shortened lead times for new product launches and advertising budgets that are shifting to digital formats where consumers are spending more time. And number 3, General Mills' pet food business should benefit from the high single-digit increase in pet adoptions during the pandemic. Its Blue brand has been growing rapidly as on-trend innovations are resonated with customers. Then for some of the key points around a potential short thesis for the business. Number one, e-commerce and an increase in digital marketing have lowered competitive barriers to entry for categories General Mills plays in. Number two, the firm has been increasingly reliant on acquisitions for growth, which adds integration risk and is generally costly as evidenced by diluting return on invested capital, including goodwill. And number three, consumers are increasingly health conscious, moving away from General Mills' categories, both its conventional fare and its high sugar, high carbohydrate organic offerings, which resulted in flat organic sales the 5 years preceding the COVID-19 pandemic. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of General Mills. Now it's time for our summary. So in summary, General Mills checks the box on 4 out of our 6 metrics today, meaning that the business looks like it's a strong candidate in terms of its attractiveness for further research. So General Mills, while they're earning average returns on capital that are better than those of a typical business, has their returns on capital fall just shy of that 14% benchmark we're ideally looking for. The business has grown their revenues, earnings, and free cash flows over the last 5 years, and they've just slightly diluted shareholders by 3.5%, so they still are growing on a per share basis as well. The business also looks like it's using a reasonable and appropriate amount of debt relative to both their average and their current free cash flows. And then while both their average and their current free cash flow to enterprise value yield did look like it was coming in slightly above the yield of the 10-year treasury, it was just below that 5% benchmark we're looking for an ideal risk premium for the business. Looking at their dividend profile, General Mills both pays out an above average dividend yield, and it looks like they were healthily able to support their dividends and a slight dividend increase over the last 5 years based off of their free cash flows in all 5 of these years, and their free cash flows have slightly grown as well over this time frame. The business maintained a moderate dividend payout ratio that was below 60% in all 5 of these years. And then finally, performing a discounted cash flow analysis of General Mills. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward to give us a baseline projected estimate for General Mills, then it looks like from today's valuations of the business, if you were looking for a 15% rate of return from the company, that a potential fair intrinsic value for General Mills is right around $40 per share. So that is down significantly from what their current stock price is at. And the last time General Mills' stock was trading at that price was back in December of 2018. You'd have to be pretty patient here if that's what you were waiting for this business. Keep in mind that there are reasons why that may not be potentially accurate and applicable for General Mills, especially because it would be an estimate for the business's future. And again, this patience may be warranted as that would dramatically be outperforming how the business has fared over their last nearly 2 decades in terms of their returns to their shareholders. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about General Mills. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company, researching the business accurately, completely, and then going back and asking yourself, what did you miss, in order to come to understand the underlying essence of the business and to understand what's going to matter and what's not going to matter for the business going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of their business, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for General Mills will be. So with that said, that's it for today's fundamental stock analysis of General Mills Inc., ticker symbol GIS. We looked at the business today as a subscriber request, so I'm happy to analyze the company, and it looks like General Mills, because they check the box on 4 out of our 6 metrics, possesses a strong level of attractiveness for further research into the business. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about General Mills with me, and have a great day.